Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken. Our model portfolio is up 5.28% year to date as of October 28th, 2023. Our goal here at SPY Trader Now is to beat the returns of the S&P 500 buy and hold investor. Their portfolio is up 7.25% year to date. What we do here at SPY Trader Now is we take investment grade capital, we invest it in the S&P 500, and we do a simple portfolio. We do either shares of the ETF SPY, or we do options, both calls and puts, or cash. Currently, you can see how the portfolio is allocated right now and the percentage invested right now. We start off the year with $100,000 and we build our portfolio from there. And one thing about this channel that's different than a lot of the other people that give you market updates is I actually show you the actual trades that I am making in an effort to get this return. So this is a no BS return on a real portfolio. And that's what we do here. If you're interested in that content, stay tuned. You're on the right video. Here are some past results for SPY Trader Now's model portfolio. We had really good years over the last 3 years. Last week, the S&P 500 lost 2.5%. That's this candlestick right here. We are at this support level right now. The question is this going to hold and we get the bounce, or is it going to slice through it and come back down to this next support level somewhere around 390-ish or 400, somewhere in that window right there? Here are the trades that we made last week. So on Monday, this was on Monday, October 24th. We bought 2 long calls. We bought the January 17th, 2025 expiration. You see how far out I went? 465 is the strike. And that premium was approximately $22.81 for those options. And then on Friday, the market declined from this purchase. And then I wanted to buy in some more, but I only went in with 1 long call. So we currently have 3 long calls, and you can see the exact trade date and the option that we purchased on that long call. Now, here are some of the trades that I made in 2023. If you want to see all my trades going back 3 years, head over to spytradernow.com. There will be a link in the description down below, and you will see everything that I am presenting today if you want to explore anything further. Now, on the yellows, those are open, not closed out trades. So we currently hold 200 shares of SPY, and our purchase price is $443. And right now, SPY is trading at $410. So we're taking a loss of $6,000 on that current position right now. And we have 2 options that I just recently took on. Those are the ones I just showed you. On the first option, we are down, let's see here, we're down $1,200, 27%. On the second option on Friday, we're just up $17. So here is our year to date, 5.22% so far. The portfolio is positioned to make money in a rising market. I have an expectation that the market is going to bounce. And as I show you my charts later on, you'll see why I have that expectation. I hope you stay tuned. Go ahead and hit that subscribe button, ring that bell, and help me promote this video by smashing that like button down. All right, now here is the equity curve for the SPY Trader Now model portfolio year to date. We took a good down hit last week because the market was soft last week, the S&P 500. Here is the equity curve for the buy and hold investor symbol SPY. You can see where they're at. Here, you can see the two portfolios combined, because here at SPY Trader Now, we don't just give you what we do, we have to compare ourselves against a benchmark. The benchmark is the S&P 500 buy and hold investor. They are in pink, we are in blue. We are very close to parity between the portfolios as is, as of right now. But once this market does bounce, my portfolio is positioned to surpass the buy and hold investor. And keep in mind that I have a large cash position. If you go back to the first slide, you'll see how much cash I'm holding. If memory serves me correctly, it's something like $18,000. So we have a very good cash position right now. Now, here is the Fed Chair Jerome Powell. Here are interest rate movements that we made in 2022 and 2023. The next Fed announcement will be on November 1st. Well, that is just a few days away. Are we going to have the 25 basis point rate hike or a skip? There is a 98% probability that we are going to skip this particular announcement on November 1st. Now, the interesting thing is that next year is an election year. Normally, the Fed doesn't like to make too many movements on interest rate movements in an election year. So I would not doubt if they skip this one, which there's a high probability they will, that they may have an interest rate hike of 25 basis points either in December 13th on that announcement or in 2024 in January. I doubt that they would go beyond January to do anything with the interest rates. So that's the last time the Fed is going to have a chance to really do any more movements if they need to. Now we are looking at things from the presidential election cycle theory. This theory states that depending upon the year of the election, you have historical rates of return. These historical rates of return are for the S&P 500. These historical rates of returns are for the NASDAQ 100, simple QQQ. Currently, President Biden is in his third year, which this is 2023, historically has averaged 16.3%. The buy and hold investor is currently up 7.25%, giving a high probability that between now and the end of this calendar year, that 7% for the buy and hold investor is going to increase and get closer, if not surpass, the 16% buy and hold investor. So there's a lot of room for this market to grow between now and the end of the year. Those long call options that I purchased, if you notice my expiration dates, are well beyond between now and December 31st. So that if this does indeed hold true to historical averages, we will greatly profit from our positions that we already have in place. Now we are looking at things from the bond market outlook. The bond market is currently saying that we should be out of the stock market because we have an inverted yield curve, meaning that the longer-term treasury rates are yielding lower yields than the shorter-term 3-month and 2-year yields. And they also have rising interest rates. 1 year ago, the 10-year was at 4.1. Now we're at 4.83. Now, the interesting thing is we're getting closer to parity. The 2-year yield is already in the 5s. The 10-year yield is almost in the 5s. If these come up a little bit more, and if the 91-day, the 3-month starts to taper down, we'll be at parity, and then if it continues, then we will have more of a normalization. And that should be expected sometime between now and the end of the year. We'll see exactly when it takes place. We monitor this each week. Now we are looking at valuation of the S&P 500 according to current market valuation, CMV, link here and in the description down below. Currently, we are 43.4% above the modern era market average of 20.2 for the PE, which puts us at 1.1 standard deviation. So here we are at 1.1 standard deviation. 65% of all trading takes place between, of all charts, I should say, between the +1 and -1. So currently we are right there. So there's an elevated risk here. So caution is advised going long. Now we are looking at CNN Business Fear and Greed Index. Here is our friend Warren Buffett. And here is his catchphrase that you want to be mindful of. Now, currently we are in extreme greed. Excuse me. Currently we are in extreme fear. We were in fear 1 week ago at 26, now we're at 24. Now this is good for us because we are taking on long positions. So when others are fearful, be greedy when others are fearful. And hence I am doing that. Now I want you to note also that I'm trading non-emotionally. I'm just trading based off of the data and the information presented. I'm not emotional about the market. I'm just doing what I believe to be the correct allocation with everything, all the data that's being presented currently. Now we are looking at a seasonality outlook. This is a monthly chart for the S&P 500. Each candlestick here represents 1 month's worth of data. We are still in the month of October. We're not closed out yet, so this is still an active month. We are at the end of the summer doldrums. There's a 65% probability for the month of October, going back 20 years, that the month is going to close out higher than when it opened. Does not look like that is going to happen where we're at right now. For the month, the S&P 500 is down 3.93%. It could come up a little bit, but I highly doubt that this is going to be a positive month for the S&P 500, which is fine. But next month, in the month of November, according to seasonality, there is a 79% probability that we're going to close that month higher than when we opened. That will help our long position because that is how our portfolio is positioned. Now we are looking at a long-term outlook for the S&P 500. This is a monthly chart, and we are going back 20 years. Bull market 2009 to 2022. We gave back some in 2022. We broke above this line, which acted as resistance until we broke above it. Now it's going to act as support. Also, you have this line here, which is going back since 2009, 2 touch points. So we're in a bull market as long as we stay above these 2 lines right here. Currently, we are above those 2 lines. Now, one thing of note, the MACD has clearly gone below its signal line. It has just happened. The slow stow is already below its signal line and below 80. The market has softened, we know that, but the question is when are we going to start to go sideways to up? That is, on a seasonality basis, the last 2 months of the year are a strong stock market, so we're expecting strength over November and December. Now we are looking at things on an intermediate term outlook. This is a weekly chart for the S&P 500 going back 5 years. And you can see where we're at right now, and we are currently at this support level. You can see that high that was made there just after 2023, so that was in January. And right now we are right there touching that, and that is a support line right there. Are we going to hold that support, or are we going to drop down? We have to wait and see when this market bounces, but I'm expecting some type of a bounce soon. We've had a pretty good, reasonable drop over a pretty good period of time. You can see how we've stair-stepped down. Clearly, we are in a downtrend since just after July. All right, now we're looking at a short-term outlook. This is a daily candlestick chart for the S&P 500 going back 6 months. You can see the candlesticks really well here. You can see how I've charted and put the trend lines in for the channels that we're in. We are currently in this channel right here. Eventually we will break out, and I'm assuming that we're going to break out to the upside on this downward trending channel that we're currently in. So we're just monitoring it, waiting for that breakout. Are we going to hold at 410, or there's some support here at 400, or we saw that at 390 there was also further support going back to the other charts. So we have a lot of support areas here. You can see the trades that I made in here along the way. Now, an interesting thing about these trades here, so on 9/26 I bought 3 long calls, and as the market came up and started to soften up and I saw that trading sideways, that's when we sold those calls. And we also placed an in the money covered call, and then we held on to those for a while, made some money. I just got out too early. I didn't know the market was going to drop so dramatically. I thought we were going to have more strength at the 420 level, but we sliced it and we are down at the 410 level right now. All right, now I am introducing a new chart to SPY Trader now. This is a ratio chart for the NASDAQ 100 and the S&P 500. Normally in bull markets, the NASDAQ 100 is going to surpass the S&P 500 because the NASDAQ 100 is more riskier equities than the S&P 500. So here we have 3 charts in one. The ratio chart is in black and red. The S&P 500 is in deep blue, and the NASDAQ 100 is in green. You see, when the markets are going up, the green line is on top of the blue line because it is acting stronger. It's advancing more than the S&P 500. That means people are on what's called risk on appetite. They're taking on that risk. The ratio chart's going up, NASDAQ 100 is going up, the S&P 500 is going up. And then here in the downward trending thing, the ratio chart is below the QQQ and the NASDAQ 100. And then here we are today where the ratio chart is above both of these particular trend lines, these charts. And we're just trying to monitor. But basically, when this line is going up, people are taking on more risk. That may have been a bottom right there. On Friday, the NASDAQ 100 had some positive gains to it compared to the S&P 500. And if that trend does continue, this ratio chart will come up, and it will come up to this top line here. So we're monitoring this, and we'll incorporate this into our weekly presentation. Now we are looking at another ratio chart. This is of the equally weighted S&P 500 compared to the normally cap weighted S&P 500. So the ratio chart here is also in black and red. The S&P 500 is again in deep blue, but the lime green here is the equally weighted S&P 500. In a bull run from 2009 over to here, 2020, you can see the equally weighted surpassed the normally weighted S&P 500. Currently, they're about at parity. Now, we've fallen off of a cliff on the ratio chart 3 times and then moved sideways. Currently, we don't have as much sideways movement right now. Once this sideways movement is taken care of on the ratio chart and we jump up like this, that is when you're going to get your bull run. That is when you're going to get your bull run. When we enter into this nice bull run after this sideways movement has passed us, which it has not yet, then we'll be in a better position just to take on long positions on the portfolio. We'll feel more comfortable taking on those long positions. Right now we're in this chaos position here where we're going up and down and up and down. So we want to be careful that we don't get caught in these waterfall declines. Well, I'm expecting some weakness come January and early next year. We'll see when we continue. We monitor the market every day, and every week we put out a video. So we're going to stay tuned to this to see when indeed this does happen. But whenever it does happen, and it could take up to a year for this whole thing to happen. It could be somewhere between 6 months and a year. This is a weekly chart. But after this does happen, we'll be in a good position just to simply take on longs. We don't have to do so much calls and puts and everything else. It'll just be calls. So we'll monitor this. Now we are looking at the VIX Volatility Index, also known as the Fear Index. You can see that there are three trading ranges here. The ultra low trading range, this low trading range because it is below 20, and then this higher trading range. When you come up into this higher trading range, currently where we are at now, that is when you can get those waterfall declines. The market, which is, by the way, the S&P 500 is in this black line right here. The market, you know what, I'm going to change that to deep blue for the next presentation to keep it deep blue consistent throughout this presentation. And for right now, guys, it's just black, okay? Anyways, here's the S&P 500, and it is now come down really softly. The VIX seems to be holding below 22, currently 21.27. If I'm correct and the market comes up, that VIX is going to drop back down into this low trading range below 20. This will hopefully happen next week and then continue to drop. As the VIX drops like it did from here to here, the S&P 500 will advance. This advance is what I'm looking for. I'm looking for that advance. So that is what I'm hoping will happen, and it will start as early as next week. One bad thing about this chart that's not helping me is the MACD. The VIX on the MACD came down towards its signal line, never reached it, bounced, and then started heading away from the signal line. That's not good. This one indicator right here tells me that the VIX wants to continue to go higher into this very high range. That's going to be bad for me the way my portfolio is currently positioned. I can still live with it. I'm going to have a pretty good loss because of the 3 call options, the 3 long calls I currently have in place. So we'll see what happens next week and see if this MACD is going to do that or if it's going to come back down. We'll see how it plays out. Now we're on the Think or Swim platform with standard deviations. Here is information about standard deviations if you are unfamiliar with them. The standard deviation +2, -2 in gold, +1, -1 in pink, and the dashed green line is the midway point. And you can see the 3 long calls that I have with the 2 arrows right there. Currently on the 1-year chart, by the way, this is a bullish chart. Why is that, Ken? Because if you look at the standard deviations from the left-hand side of the chart to the right-hand side of the chart, we're traveling north. That means the market is traveling north, generally speaking, as a whole, over a 1-year time period. Now, we are currently at the -1.8 standard deviation. There's not much room to go before you hit 2, and then you have a 95% probability of a bounce. Now we are looking at the same chart, but instead of going back 1 year, we're only going back 6 months. Now we are still bullish because the chart is traveling north. Currently, on the 6-month chart, the market is at -2.2 standard deviation. So there's a higher than 95% probability that we are going to bounce from here. It's not a guarantee, it's a probability. Now we're looking at the same chart, but we're only going back 3 months. Now we know that going back 3 months, we are in a downturn. So for a short-term time frame, 3-month time frame, look at your standard deviations from the left-hand side of the chart to the right-hand side of the chart. We are traveling south, so we know the market is coming down. And I also gave you my sell and buy zones. Now, once the market does find its footing and does bounce, and it comes up into this sell zone, we need to determine if we want to sell our long calls, keep our long calls. How exactly do we want to play the market once we get to here? I guess it depends on how strong the market is, because if it starts showing signs of doing this, we'll probably want to take our long calls off the table for a profit. Anything over this line right here is going to give us profit on our first position, and anything over this line right here, about 415, will give us profit on our second position. So on our first position, we need to be above, let's just say 422, somewhere in that neighborhood. Yeah, right about 422, maybe 424, 425. We start going above that, we know we're going to be profitable. And of course, we're going to be making money in our 200 shares of SPY at the same time. Okay, I just gave you a ton of information in this video. Now comes our critical thinking. What are you going to do with that information? This is the part that all those other guys that just show you what the market is doing, they don't tell you exactly how they trade it and put it into a portfolio on how you can actually diversify yourself so that you don't get wiped out. Okay, as of October 28th, 2023, the market summation, according to me, Ken, your host with Spy Trader Now, on Monday and Friday of this past week, I placed long call options trades. I already showed you those in great detail earlier. As you know, I am bullish and looking for a meaningful bounce next week. It may not happen next week. I may be wrong. And even if it does, I'm not really sweating bullets. I have a large cash position, $18,300 in cash. So depending upon the market action will determine my next steps. If the market corrects further down and the 410 level does not hold, but we appear to hold the 400 level, I will buy another long call, just one. If the market does start to bounce off the 410 level and it gets its footing now, I may still buy one more long call just so I can put some more leverage and money to work at this low oversold condition. We are in a good position as we are holding 18,300 in cash. I'm not fully invested in cash like the buy and hold investor. Their hands are tied. They can do nothing. They're just simply holding their shares and at the whim of the market. Whereas with this strategy, you have the ability to make changes depending upon what the market is doing. That is the benefit of a strategy like this. But that's only beneficial if we can beat the returns of the buy and hold investor, which I'm hoping to do in the next 30 days, and then maintain that for the remainder of this calendar year. Overall, I'm expecting weakness till the end of October, which, by the way, is going to end next week. We are right at the end of October, and then strength till the end of December. I hope you have got some valuable information out of this video. If you have not done so already, go ahead and hit that subscribe button, ring that bell, and help me by smashing that like button down for me right now. I thank you, and I wish you good trading.